The top business stories live from the Sky Newsroom. Ofwat says it will stop customers having to pay for undeserved bonuses for water bosses. I'll be speaking to its chief executive. A blow for the Chancellor as government borrowing comes in higher than expected. Plus, JD Sports shares tumble following a slump in sales last month. Very good morning and welcome to Business Live with me, Darren McCaffrey, on this Thursday. Thank you for your company. We're going to start with the news about the nation's finances because in a blow for the Chancellor today, government borrowing rose to £17.4 billion last month. That's higher than expected and the second highest October figure since monthly records began. Let's speak to Rahul Rupel, who is the director of Centre for Growth and also a former special advisor, of course, to Theresa May. Rahul, thank you very much indeed for joining us. Frankly, these figures are not good.
Well, I think it will be a concern, as you say, because they come in higher than expected. But I think particularly looking back at the budget and forward to the spending review in the spring, the Chancellor has left herself limited fiscal headroom in terms of what more she can do. And we know that there are going to be further upward pressures on spending from borrowing costs that have risen since the budget. But also, as we saw in this data, the benefits spend coming in slightly higher than expected. But also, we know they're launching an industrial strategy in the spring and there's going to be an expectation that there will be funding put behind that. So I think the concern will be that we're coming in spending higher than expected, but with a view that there's limited fiscal headroom and potentially more upward pressure on spending to come in the next few months.
And that's a real concern because, of course, the government have talked about trying to get the country's finances in order. They've raised taxes and the expectation is that they shouldn't need to raise taxes again. But if time and time again borrowing continues to increase, that pressure only grows, doesn't it?
Yeah, it will force the pressure for potentially further hard choices. Look, it may not necessarily have to manifest itself in higher taxes. One thing we do see is that they have significantly front-loaded capital spending and capital investment in the recent budget. And I think my personal view is that it's quite unlikely that they will be able to get a lot of that money out the door as quickly as they expect. So come next spring, they may actually have underspent on some of that funding, and therefore that could be reallocated to some of the day-to-day spend. Now, from an economic growth perspective, that's not optimal because we do want to invest more, but from a kind of spending perspective, it does allow for some moving around. So there are things they can do to potentially or might be able to do to adjust for this higher spending, but it will cause challenges for their fundamental plan, which is to invest more and, as you say, manage public finances in doing so.
I mean, the good news, of course, is that tax revenue was up, but we had a strong economic start to the year, and yet we've seen that growth slow.
Yeah, so look, as you say, the receipts have kept pace with the rise in spending, which is good. And if you look compared to last year, our path of public spending is only around £1 billion above where it was this time last year. So higher, but not significantly higher and not totally out of line with the path that we saw last year. That being said, one concerning thing will be the VAT receipts because it shows that consumer spending has been relatively weak. And we know that people are saving more and spending less. And so that could continue into the new year, which could hamper the rise or the accumulation of receipts going forward. And so there will be some concerns there. And obviously, as you say, it banks on the fact that we continue to have a strong economic growth picture going into the start of next year. And obviously, with the recent budget and the tax rises announced, we know both consumer and business confidence has been hit. So there will be a hope that that rebounds. But if it doesn't and the start to next year in terms of growth is a bit weaker than expected, that could also cause problems on the receipt side. And so a negative combination there of upward pressure on spending and downward pressure on receipts is something they'll want to avoid. So I think it shows the premium of continuing to set out the path forward and make clear kind of how the budget and the government are going to support growth and support the economy into the start of next year.
OK, Rahul Rupel, director there of the Centre for Growth. Thank you so much for your time this morning. Really appreciate it. Thank you. Now, the water regulator says that 9 companies, including the beleaguered Thames Water, will be blocked from using customers' money to fund what it calls undeserved bonuses for top bosses. Ofwat says it is stepping in to use new powers to prevent customers paying nearly £7 million in bonuses across the industry. Well, joining me now is David Black. He is the Chief Executive of Ofwat. Good morning to you, David. What are you trying to achieve? What's the purpose, if you like, of this intervention today?
Good morning. Yes, the purpose of our intervention is to rebuild the trust of customers of the water sector. So we've seen water companies disappoint customers with sewage discharges, excessive leakage, and then alongside that, we've seen chief executives earning multi-million-pound bonuses. So these interventions today will ensure that customers are not paying for undeserved bonuses, and we think that should make a contribution towards rebuilding the trust that customers have of the sector.
So it's about rebuilding trust. Is it also a punishment?
No, we don't see this as punishment. This is about making sure that companies are paying bonuses only where they've been earned by performance for customers and the environment. It's what customers would expect from water companies. And so we need to see company boards stepping into this and making sure that executive pay packages match the delivery for customers and the environment.
But frankly, David, let's be honest about this. This is tinkering around the edges, isn't it? I mean, the water industry, the entire industry is a mess. I mean, 7 million quid is neither here nor there. I mean, it is tinkering around the edges.
No, I think that's not correct. I think executive bonuses are an important issue from a customer perspective. I get a lot of letters from customers that reflect that. It comes up in customer engagement that we do. But you are right in the sense that much more needs to be done, which is why at the next price review, we're going to be backing an investment program which at least trebles the investment in the sector, and why we're raising the bar on company performance. So we need to see a huge amount of new investment. We need to see company culture change, and we need to see companies step up their performance. The changes, the announcements today is all about helping rebuild customer trust and seeing the sector culture change from one where they dodge accountability for outcomes to one where they take responsibility.
Well, we're talking about dodging accountability. I mean, I'm reading the remit here of Ofwat, which is apparently being responsible for making sure that the companies we regulate provide customers with a good quality and efficient service at a fair price. When was that last achieved?
So it's our responsibility to regulate companies to drive outcomes for customers. We're not running companies. We're not responsible for delivering the service. What we are responsible for when companies perform poorly, we step in. We've done that. We've imposed over £400 million of penalties where companies have fallen short in this current regulatory period. We've got live enforcement action where companies have broken the law, imposing penalties of up to £168 million on 3 companies we announced earlier this year. So we are taking action where companies fall short, but that is insufficient in itself. We, as I say, want to see the sector invest more. The next price review will back a record level of investment. It will be a huge investment program by any standards. It will take the water sector forward, move us beyond a lot of the international practice, which we see on things like sewage discharges. So change is needed, and we're here to help drive that change, but we can't do it by ourselves.
I come back to my original question is, your remit is to provide customers with a good quality and efficient service at a fair price. As in, you're responsible for ensuring the industry does that. When did that last happen?
We regulate the sector. So we are seeing some companies do much better than others. So we are seeing some companies rise to the challenge of having 0 serious pollution incidents. We want to see that take place across the sector. The issue of sewage discharges is one that really concerns people. The law as it stands does permit legal discharges. What we're stepping in to stop is the illegal use of discharges.
Yeah, I suppose, David, what I'm trying to get at here is we all accept, I think you would accept, I don't think anyone doesn't accept, is that the entire industry is a mess. We've got companies that are struggling to stay afloat, no pun intended, with enormous amounts of debt. We have got, as you say, the issues around sewage, and we've got increasing bills, and they're likely to rise yet again this year. So it is not working for anyone. How much does Ofwat, the regulator, take responsibility for being part of that problem, of that mess?
So we think that the regulatory framework needs to change, and that's why we're introducing changes like the announcement we've got today. That's the first time we've taken action to prevent executive bonuses being paid where they're not justified in the customer's interests. We're talking about the next price review where we'll treble the level of investment. We think there are bigger issues in terms of sector investment planning. So the sector clearly hasn't invested enough historically. The reasons for that needs to be addressed. So we would agree that change is needed, but I think it's equally unwise just to look at one regulator and say changes there are going to change the sector.
But it comes to the point that looking at your remit, to me, I don't think you're fulfilling your remit. I don't think that remit has been fulfilled for many years. I mean, frankly, people would say that Ofwat's just not fit for purpose.
So we would disagree. So we, as I say, we've got clear. We know where the sector's falling short. We've got actions to address those issues. I think it's easy to criticise the sector, easy to admire the problems. What I'm focused on is taking action to address these issues. And so I think just to somehow or other criticise the regulator for taking action, for holding companies to account, for identifying issues and for acting on them. I just don't agree that that's the wrong thing to do. What we are doing, we're changing the sector, we're pushing it to change, but ultimately we are the regulator. We're not providing the service, and I think that's the important distinction that needs to be made.
No, and I get that, and we'll leave it there. But I mean, you all there responsible to ensure that they do provide a good service, and I don't think anyone would suggest they are providing a good service at the moment to their customers. But we'll have to leave it there. I'm sure we're going to come back to this, David, and we do appreciate your time this morning. Thank you very much for coming on and you taking those questions as the Chief Executive of Ofwat. Thank you, David.
Thank you.
To get in touch about that, I'm sure you will. Now, let's move on. The pensions industry is going through a bit of a transformation at the moment, I think it's fair to say. The Chancellor, Rachel Reeves, is planning a major overhaul, bringing in a number of mega funds to help drive investment. XPS Group is a consulting and administration business which specialises in the pension sector. It's just published its half-year results, which show that revenues increased by 23% to £113.4 million. Let's speak to Paul Cuff. He is co-chief executive of XPS Group and joins us now. Paul, good morning to you. Quite significant increase there in revenue. What's driving it?
Yeah, our clients are very busy. They need a lot of support. The world is changing rapidly around them. The big changes in interest rates rising in recent years, means that a lot of our clients now have a whole new outlook on their strategies and a wide range of options opening up to them. And they need a lot of advice and support about how to deal with those options and changes before them.
And you talk about the fact there is lots of changes taking place. I mean, are you excited? Are you encouraged by the changes, particularly that we saw in this budget from the new Labour government?
Yeah, I think honestly it's a mixed bag, actually. I think the objective of the government is clearly to drive growth in the UK economy. The thing is, for the people running pension schemes, they have a slightly different objective, which is fundamentally to provide the pensions to the members of those schemes. If they're in a defined benefit scheme, to make sure those promises get honoured in full. In a defined contribution scheme, to drive good returns so that members get good outcomes. And that responsibility is a little different to having any kind of responsibility about driving growth in the wider UK, although I'm sure we'd all love to see that be a consequence of the decisions that are made in running these pension schemes. Now, I think the government has signalled some things that will help on both fronts, will help to drive some better returns, but it's a slightly mixed bag, and there are indeed a few omissions in what the government's been talking about.
What are those emissions then? Why the concern, if you could spell it out?
Well, there's been a big focus on these giant defined contribution schemes, these mega funds and so on. And there are some interesting ideas that larger schemes might be able to drive good returns. But the key is in that industry, there's been an unrelenting focus just on cost and not on value net of that cost. And I think that's what we really need to see a mindset shift in, because you'll never be able to invest in things that drive lots of growth unless you're willing to accept that there's an initial cost ultimately to go and do that. So that will help if we can see that mindset shift. And I think the government do want to see that. The biggest omission, though, I think, was in defined benefit schemes. In the private sector, there is £1.2 trillion invested in defined benefit schemes. And a lot of those pension schemes are now in a really quite healthy financial position. Many of them have moved into surplus. And companies and trustees, people we work with every day, are very keen to try to unlock some of that value, perhaps to give higher pension increases to members whose benefits haven't kept up with high inflation in recent years, or to spend some of the money on really high quality defined contribution pensions for the future. And if the government unlocked that, by the way, there was no mention of any of that whatsoever in the Mansion House speech, then it could have the effect of positive growth in the UK economy as well, because that money flowing into defined contributions and so on would be flowing into long-term growth assets in the UK economy, driving better outcomes for members and ultimately driving better outcomes for the UK society as a whole, which is something we'd absolutely love to be able to get behind.
Okay, really fascinating stuff, and appreciate your time this morning. That's Paul Cuff there from XPS Group, the co-chief executive. Thank you, Paul. Now, the top performer on the FTSE 100 this morning is Halma. It's a health and safety device kind of company, if you like, and its shares are up 9% after its half-year results showed revenues rose 30% year on year to over £1 billion. Let's speak to its chief executive, that's Mark Ronchetti. Very good morning to you, Mark. I mean, I think it's fair to say that Halma is not a household name. You're a FTSE 100 company, but not a household name. Talk us through what you do, if you like.
Yeah, morning, Darren. And as you say, absolutely fantastic to have been able to announce another set of record results for us this morning. We're on track to deliver our 22nd consecutive year of record profit growth. So fantastic to be in that position. Fundamentally, in terms of what we do as a business, we're a global group of around 50 companies. We're focused on solving some of the biggest challenges in the world around health, safety, and the environment. So we're looking at businesses that are solving some of those big problems. We're looking at niches within those businesses. And then we're operating a decentralized autonomous business of around 50 companies, each of which has the autonomy to make the right decisions in their businesses, in their countries, for their customers. And that's enabled us to deliver that long track record of growth. So very much a nice combination between positive purpose and financial results and long-term sustainability.
And I suppose, in many ways, Mark, where is the most exciting new element? Where is the real strong growth coming from across those kind of various different sectors?
We see growth across the whole of the group. In fact, we've invested across all three of our sectors in the safety sector, environmental analysis, and in healthcare. So over the medium to long term, we definitely see growth in all of those areas, and we continue to invest. The same then geographically. When you're focused in those markets that are underpinned by those long-term drivers and you're really solving some of those bigger issues, it gives you that level of confidence to continue to reinvest in your business. So again, both through M&A and through organic R&D investment, not only have we delivered a really strong set of results in the last 6 months, but we've continued to invest to ensure that we can continue to grow for the future.
And when we look at actually mergers and acquisitions you talked about there, we know the Competition Authority is going to explore that a little bit more about mergers and acquisitions in this country, about whether potentially it's actually holding Britain back, some of the rules around that. Do you feel it is right it's being looked at?
But for us, we're focused on buying fantastic, often privately owned businesses and giving them a home to continue their growth strategy moving forward. We're seeing that globally. We're talking at any one time to around 600 or 700 companies, all underpinned and again aligned to our purpose. We have made some great investments in the UK. In fact, only 2 weeks ago, I was down in a business that we brought into the group this year called MK Test down in the southwest of England, and fantastic business. Really looking forward to what they can bring forward. And at our level of M&A, we're excited by those prospects.
Okay, so bottom line is, Mark, that, you know, London is still good to be a FTSE 100 company, and the UK, you're quite optimistic about the future, briefly.
Oh, absolutely. We've been listed in the UK for over 50 years, and we've taken our market capitalisation on the UK market from around £1 million up to over 10 billion as we are today. So we've got a great diverse level of investment from shareholders, and we're pleased with where we are. Okay,
Mark, appreciate your time. That is Mark Ronchetti there, the Chief Executive of Halma. Thank you very much indeed. And Halma, one of the big rises today. If you were an astute viewer, you would have had a sneaky peek of the FTSE 100 during that interview. It is up slightly this morning. We'll have all the details with the market news in just a couple of minutes. Stay tuned.
Migrants risk their lives climbing aboard these trains in search of a dream, the United States. is really dangerous. They often get robbed on this train.
They suffer a lot by police, cartels.
What happens to them next, we just don't know. Do you miss your mum?
With Trump coming to the presidency, how much longer will people be accommodated?
The journey you've been through, it's been very difficult at times. Has it been worth it?
See.
This is a journey which goes by one name, the Beast.
We are under Israeli military restrictions in terms of some of the things that we can film, but it's important to be in there. What a slow drive for the president as he approaches his golf club.
4 more years!
Free wherever you get your news. I'm Mark Stone and I'm Sky's correspondent based here in Washington, D.C.
Trust in politics is at an all-time low. What's going wrong and can we fix it? It's from Liz. She wants to know, why is there still no sign of the Labour Party electing a woman as leader?
It's sort of embarrassing. You know, it takes a very strong man to be leader, but it takes an even stronger man to support a woman for leader.
If you want to be mean to politicians, like, crack on. The activists that go out and make elections happen, I kind of feel like just don't be horrible to them. Be polite to them in the same way that they're polite to you.
Keir Starmer has got us into government with a big majority. He was completely clear before the election that he wasn't going to be able to do the two-child benefit policy, but I wouldn't be surprised if it isn't an early thing that comes along.
I went up to Gordon Brown and said, hello? No, yes, where is it? I said, found all these Tory candidates breaking land. Let me see it. This is brilliant.
This may be the Premier League.
I'm not like everybody else.
But this duo have been in a league of their own. It's Haaland, a striker like no other.
Like everybody else.
Son, Starman for Tottenham Hotspur.
Like everybody else.
That's just stunning. Wow!
Everybody else. Like everybody else. Like everybody else.
Manchester City, Tottenham on NBC and Peacock.
Very welcome back to Sky News. We're just going to bring you some breaking news that's come in the last couple of minutes. And as you can see at the bottom of your screen there, that is the International Criminal Court. The ICC has issued arrest warrants for the Israeli leaders, Benjamin Netanyahu, of course, the Prime Minister, and the former Defence Minister Gallant. It has also issued an arrest warrant for the Hamas leader. That news coming in just in the last couple of minutes, that the ICC has issued arrest warrants for different leaders, effectively, in different parts of that conflict in the Middle East. And we'll have more on that story, of course, at midday. OK, let's take you through the markets, though, on this Thursday morning. And stocks in Europe opened up, as you can see, on a rather mixed front. Here in the UK, the FTSE is currently up with Halma, which is talking to them, up by 7%, as you can see. So that's boosting the FTSE overall. JD Sports, though, the major faller, falling through a tough trading time. Shares down nearly 14%. If we look at the currencies, the pound is again down against the dollar today. It's been really hammered by the dollar in recent weeks, up a fraction against the euro. And if we look at a price of Brent crude oil, it'll cost you nearly $75, actually, up a couple of percent this morning. OK, let's bring in Rachel Winter, partner at Killick & Co. Very good morning to you, Rachel. Let's start with JD Sports. What's happening there?
Yeah, quite a surprisingly strong share price reaction here. So the company had a trading update this morning. It was a little bit weak, but I didn't think it was too bad. The company said that profits for the full year are likely to come in at the lower end of their previously guided range, but still within the range. And despite that, we've had the shares down about 15% at one point this morning. The reason they gave was that trading has been quite volatile. They said that we've had some mild weather here in the UK and also in the US, and that has delayed people's purchases of the more expensive cold weather clothing. So that's one reason why revenues have been a little bit lower than expected. But I think more broadly, there are some wider concerns about demand in the sportswear industry. For example, Nike, which is the world's largest sportswear company, their shares are down about 50% since 2021. So I think there are some concerns about a lack of demand in the industry more generally.
Let's move on to a company that we don't talk about an awful lot, an airline we don't talk about an awful lot, but actually one that passengers really like, and that, of course, is Jet2, who's seen the profits rise.
Yeah, great results this morning. So profits are up about 14%. The company has had record passenger numbers, which is great to see. For me, the most interesting part about this update was the comments on employment costs. So the company said that staffing costs have gone up about 17% over the last year, so really significant wage inflation there. And there was also a negative comment about the impact of the recent autumn budget. So the company said that the 2% rise in employer contributions for national insurance are going to cost it £25 million per year.
Let's talk about Unilever as well. The owners, of course, of Ben & Jerry's ice cream, and they've been trying to get rid of that. And actually now they have stopped, I think, what's going to be worth 15 billion euros.
Yeah, so they have been trying to get rid of the ice cream business for some time. They had been looking at either selling it to a private equity business or listing it separately. There was a report in the Financial Times yesterday, which is not yet confirmed by Unilever, saying that they haven't been able to find a buyer and therefore now they're looking to list it separately. I think it has been quite a difficult couple of years for ice cream producers. There's been so much volatility in some of the commodities that are needed, for example, cocoa, dairy products, and even energy. And also the supply chain for ice cream is very complicated because you need so many freezers. So I think those are some of the reasons why Unilever is trying to get rid of that part of the business.
OK, Rachel, great stuff. As always, thank you very much indeed for your take on the markets there, Rachel Winter. And we should just reflect that NVIDIA, of course, who make chips, they're doing incredibly well at the moment. The revenue for the end of the quarter up to the end of October nearly doubled from a year ago, up 94%. So they're doing incredibly well with that £35.1 billion worth of revenue. OK, that's it from me on Business Live for today, or well, for this afternoon. I'm back at 4:30 with Business Live. Do join me then if you can. Stay tuned though, Kamali Melbourne is up with the very latest news headlines, including that breaking news on the ICC issuing arrest warrants. Do stay tuned for that, but I will see you at 4:30.